Hello, good morning, good afternoon, everybody. Welcome to our December market commentary. We have a lot of good information today. Obviously, a lot has been going on. And as we look forward to 2025, we want to kind of set expectations for what we're looking at, what we're seeing. As just a reminder, this will be up on our YouTube channel. And we are going to take some questions towards the end. We will also make sure that we mention a little change that we're going to have to our presentation schedule next year. So make sure you stick around for that. So Austin's going to go ahead and just lead us off today in a little bit of information. Just before he does that, a quick background. My name is David Sedia. I'm a chartered mutual fund counselor here, over 10 years of experience. And then Austin is a certified financial planner, CFP, with over 6 years of experience in the industry.
All right, thanks, David. So if you've been on these commentaries that we've done in the past, right, what we're doing here is we're looking back at the past month at what's happened, and then taking the other way, looking at the future, seeing if we can try to give you guys some insight on what we see from, I guess you could call it the inside of the industry, right, on what's going on. As if you sat on these conversations, a lot of times we're looking at, hey, here's the pros, here's the cons, and what can we do with that? And it's more of the same this time. So a small thing happened, right? In November, we had a national election, and a lot of people were concerned about the results of that, what was going to happen, how was the market going to react. And so let's look, what's going on with the market here. Well, first of all, consumer confidence, which is, when the conference board here is polling consumers on how they view the economy, the stock market, all of this, consumer confidence has been rising, and we're at kind of the top of this range that we've seen since, back at the end of 2022, heading into 2023. Okay. Typically, what we see is consumer confidence, as you would imagine, rises as the economy is doing well, the market's doing well, and peaks, just before things are about to get a little bit rough, or after it has gotten rough. Analysts, when you look at analysts, all these big banks, right? Goldman Sachs, Morgan Stanley, Barclays, they all have analysts who are making or creating expectations on what the market's going to do over this next year. Here at Capital Financial Planners, we don't make too many of these assumptions or expectations, as we've said before, but it's always interesting to look at what a few of these big banks that are paying their economists lots of money are expecting for the next year. And overwhelmingly, the analyst expectations for S&P 500 returns in 2025 are positive. So right now, the S&P 500 is right here, floating right around 6,000. All of these large banks are expecting growth in the S&P 500 next year. And to put things in perspective, if you look at the historical average in the S&P over the last 50, 75 plus years, average growth level annualized is about 10% a year. That's what this dotted line here measures. And so what you can see is most of these analysts are expecting average to slightly below average growth in the S&P 500, with Yardeni up here at a pretty high expectation. Now, there's another side of this, okay? There's still this elevated anxiety, or there's economic indicators pointing to the fact that we're still at elevated risk for a recession, okay? There are a group of indicators called the leading economic indicators that have historically been fairly accurate in predicting or leading to recessions. Okay, so you can see all of these gray shaded areas here are recessions. And you can see when those happen are when these lines peak, right? Most times that they cross this line right here, there is a recession within, a year or two following that. So far, we have been up here for about a year and a half with no recession. And so this is something that we're still keeping our eye on, right? And we're at odds right now. This is at odds with all the consumer sentiment, with all of the analyst predictions on what the economy is going to do. And so what we're going to talk through today is why that is, why there is still some nervousness around the market, but also why there's some reason to be hopeful, okay, or optimistic. So, David, let's talk about what's happening right now. What's leading to some of these thoughts about potential, good markets or recessions?
Yeah. So the biggest thing that obviously in the past 2 years, 3 years, so this has been a main topic of conversation is inflation, right? Inflation peaked at 9.1% back in summer 2022 and is now really come down, right? It's in the 2 and 3%. And it started to level out, right? Meaning if the Federal Reserve really wants to get inflation below the current around 2.5%, they want to get it to 2% or lower for core CPI. And that's excluding food and energy prices from that. But if they want to get it below 2%, something's going to have to change, right? And one of the things that we've seen is they did start to cut interest rates because they were concerned that, hey, maybe they overdid it, right? Maybe we are leading or heading into that recession, and that's why they want to try to curb inflation well if they can, trying to avoid a recession. So with inflation leveling out, that means that they might need additional monetary policy to help bring inflation down to their target level. And that also means interest rates are probably not going to come down nearly as fast as one might have expected or thought about. When we look at the next chart here, trying to avoid a reacceleration, if we look back to the 80s, you'll see in the 70s is the last time we had a peak in inflation like the one we just experienced in 2022. And they brought inflation down, but then they were a little too overzealous, right? Cutting rates. And what happened is inflation went right back up and resurged. So what they're trying to do is they're trying to avoid that from being a recurrence. And what that means is we're going to see very likely these higher interest rates for a longer period of time. And they might come down just at a very gradual pace. We're not going to see these large cuts next year and the year following. So, as this starts sharing here, the expectation has become now that we should see higher interest rates for longer. And that's where we had a little bit of volatility in the markets right after the election. And we've seen some more volatility in the bond market, is because this is now being priced into markets. And with a Trump presidency, and I know that from last month's commentary, which you can definitely go look at the slide from it, there is a great slide that showed the kind of anticipated inflation rise during a Trump presidency. Not a huge rise, but a rise nonetheless back into around the 3% that we might see over the course of this. Some of that due to tariffs, some of that due to potentially reduced taxes, which we'll be spending a lot of time talking about next year. But this has become now that expectation is, hey, we will reasonably see inflation here stay a little bit, interest rates stay a little bit higher.
Yeah, and to chip in here on this chart, I think it's really interesting to take a step back sometimes. We've talked a lot about the relationship between like the federal funds rate. So when you hear about, hey, the Fed lowered rates or the Fed raised rates, that doesn't have a direct relationship to what bonds do, right? That have interest rates, or what your mortgage is going to do. Like there's a lot of people that there's this misconception that, hey, the Fed lowered rates, that means mortgage rates are going to drop. Maybe I can refinance now. And I like this chart here because it shows that those things aren't directly correlated. So what I want to point out here is, so in blue, we have the federal funds rate. Okay, so this is what the Fed is controlling. And that's a very short-term rate. That's like what banks use to loan money back and forth to each other. That's like what your high yield savings account maybe is going to pay, is going to be really tied to the Fed funds rate. But then you have bonds, and those bonds are on, different timelines. So a lot of times we look at 2-year treasuries and 10-year treasuries. And those are going to be more based on where is it anticipated that rates will be in 2 years and 10 years. And so you can see what was happening here when the Fed started dropping rates. People got really excited and bonds started pricing in, rates are going to be dropping. We're going to go down here. And then what happened is, one, there was the Trump presidency, also inflation, kind of leveled off, like what we were pointing out before, what David mentioned before. And so it was looking like, hey, even though these short-term rates are dropping, they're not going to be in the future. They're not going to be dropping as fast as we thought they would. It's going to be more like this. And so all of these bond yields and these bond rates have come back up to account for this expectation that rates are going to be higher for longer. Mm-hmm. And how that impacts things that most people care about, right, is like your mortgage rates. I mentioned this before, but you can see how this has a very strong correlation to the 10-year treasury. The 10-year treasury and mortgage rates have a very strong correlation. So they peaked, they started to dip. Same thing happened over here, right? They started to fall off here when it was looking like, hey, everything is good, inflation's coming down, all of this, and recently have picked back up again because that 10-year treasury yield is looking like it's going to be higher for longer. Okay, so I know a lot of this can be seems kind of counterintuitive, right? The Fed's dropping rates, but mortgage rates are rising, auto loan rates are rising. Why is this happening? And it's because of this assumption that we're not quite out of the woods yet when it comes to inflation, and the Fed's going to do everything that it can do to prevent that re-inflation that we saw back in the 1980s. Now, while we're talking about housing, this is a part that we've talked about in a couple of these calls, but we haven't dove in too far. Now, when we look at inflation numbers, inflation is made up of all kinds of things, right? We're looking at core goods, we're looking at shelter, we're looking at medical services, transportation, right? But then what we're showing here is all of these things contribute to inflation, but shelter specifically right now is contributing a disproportionately high amount. Most other goods and services have come down to a very reasonable level of inflation, but shelter housing prices has remained quite stubborn. And one thing that the Fed is keeping in mind is, if we think about this, if they were to lower rates too far to the point where mortgage rates really did drop a significant amount, that would reignite the housing market and potentially cause houses to become even more expensive, or housing to become even more expensive. Mm-hmm. So all of these things play a role, right, where it's going to be really important for that housing price to come down. And to put this into perspective here, right, if we look at overall inflation right now, it's here, it's right around this 2.5%, 3%. Shelter is way up here on its own. If you were to remove shelter from core, we would already be under this 2% target, and we would have been pretty much all year, right? So in true terms, with inflation has really come down quite a bit, but shelter is what's holding us up here. So that'll be interesting to watch over this next year and see how that all pans out. So What we've looked at so far has primarily been interest rates, inflation. We're looking at some of those things, some of the reasons that the economy is maybe not 100% out of the woods yet, why there's still a little bit of that fear of the recession looming, even though there appears to be a lot of strength in the market. Um, but now let's look forward, and let's look into the market and in maybe some areas that are stronger or weaker within the market so that we can look at how to invest going forward. So David, you want to start us out there?
Yep, absolutely. So where we are right now, and definitely in any of the meetings I've had with my clients, one of the big things that we've talked about is stocks are looking a bit pricey right now. All right, the stock market has gone up tremendously over the past, really, since 2008. Right, we had one bad year in 2022, but for the most part, every other year has been really strong. Right, we've been exceeding the market's average of 10% for so many years, and it's led to these high valuations. And one of with the projection, right, still for next year being around 10%. One thing we do want to stress is this is not a reason to be super concerned right now. What this is a call to be a little cautious, right? A call to be diversified, and we'll spend some time when Austin, you talk about the next couple, and when you jump in about how you can go about that. But stocks are pretty highly valued right now. And if we look at the price to fair value, and notice every time we get above this red line here, right, you tend to see a little bit of a correction back down, right? And that's kind of where we are again, right? We're at 1.05, and it's very likely we see that kind of dip back down just a tad here. Now, does that happen next year in 2025? Potentially not, right? With those expectations, that might feed into 2026, but it's going to depend on a lot of things that none of us really know exactly how they're going to work out with tariffs and how that impacts the economy and various companies and prices and inflation and what the Fed does in turn through that. So there's a lot of variables here. And we're going to be covering a lot of that next year. And I think even in January, we'll be talking a little bit about that part. But you just want to set an expectation that we might see things soon come down, but we're not calling for a change just yet. So, on that note, um, we want to understand how stocks exactly work. And one of the early things I like to do with a client is I like to explain just, let's not call it basics, but some of the differences in stocks and bonds and how they all work and how we create our portfolios around this. And one of them is just understanding that stocks are broken up into two categories, right? You have growth stocks and value stocks. A growth stock is a company that takes really all the earnings that they're earning and reinvest it back into the company, right? Their primary goal is to increase the value of the company. A value company is, and I like to use Walmart or Costco. I think they're two great examples. Let's use Walmart. Walmart has, for the most part, almost all the locations, right, that are very profitable. And if they were to take all their profits and reinvest it into new stores, well, at some point they're just opening stores for the sake of opening new stores, right? Because they had the money. It's not a feasible thing to always open a new location. So what these value companies do is they will kick back profits to investors in the form of a dividend, right? A share of profits with the owners, any shareholder in that company. So value companies, they may not be growing as quickly as the growth companies, but they are also normally a little less volatile than those growth companies when markets have their fluctuations. And in an efficient portfolio creation, you have a good balance of growth and value between your stock portion or allocation in your account. You never want to have too much, either one way or the other. And right now, what we're seeing is a idea that you may want to tilt your portfolio to have a little bit more value, right? You want to be close to 50-50, but you want to tilt one way or another depending on where the markets are. And what we see on this chart is on the left-hand side, we have the growth companies, right? And on the bottom, you'll see the average PE in that box is 41.7. Now, let's break this down into English. What does that mean? That means that the average share price compared to the earnings of the company is 41.7 times the company's earnings. In other words, somebody investing in these companies needs to reasonably think that company is going to grow 41.7 times its current earnings in the reasonable future, 2, 3, 4 years. So that is how that investor makes money. And if that price to earning ratio increases, the investor may make money. But if that company reports earnings and they're not as great as expected, right? Still good earnings, still making money and doing better, but not as good as what would justify 41.7 times, their share price will go down. So even if they're still performing, their share price could go down. 41.7 is a very high PE ratio to see. And we can all see, I think one sticks out here, which is Tesla, which is trading far above at 101. Amazon's come down a little bit. It was actually much higher previously. And we have ServiceNow at 62.5, but we can see that most of these are in that kind of 30 range. The average for the S&P 500 itself is much lower. It's around 15 to 16. So on the right-hand side, we have these value companies, right? These are still stocks. They are, again, those more dividend-based companies, and their average PE ratio is 18.9. Still, again, a little bit above the average market. These are the top 10 companies, right? So these are going to be larger companies within the value or growth category here. But the main thing here to see is all of these are currently above the average markets, but the growth is so far above than value. So right now, we're in the camp of being a little bit defensive, having a little bit more towards the value part, which I know is a little difficult to do at TSP because you have the CNDS, and both of those funds are tilted towards growth. So the only way you can really have value is if you use the mutual fund part of the TSP, or if you use outside investments and you use that to give some value to it. But we're in the idea that we still think markets are going to grow, but it could take an event or two that are unforeseen to maybe send prices lower, and that's where you want to have that value tilt so you can preserve your portfolio a little bit. So that's talking about, more so these are just the large companies. I'm going to turn it over to Austin here, and he's going to talk about further diversification than just growth and value. And he's going to talk about these medium and small companies and give you a little insights there.
Yeah, thanks, David. So, yeah, the valuation thing is something that if you've been listening to this, we've been talking about this for probably a year, right? That it's been a concern for us how expensive some of these companies are getting. We understand that there's a lot of growth going on right now. Earnings are growing, but the question we have to ask ourselves is that earnings acceleration sustainable, right? So another thing to think about, right, is companies that, like David said, that are on the growth side, that are pouring all of their revenue back into the growth of the company. What happens to a company like that when the economy slows down and can no longer support the level of consumption that we've seen? We saw that actually after the pandemic. If you think about this, like the work from home trend sent companies like Zoom and Salesforce and anything that supported a work from home environment skyrocketing, right? And they were pouring resources in, and they were hiring people like crazy because everything was growing. And then life kind of got back to normal, right? And not as many people stayed working from home as they thought, and everything had to come back to earth. Like they got ahead of their skis. And so when we just, our job as investment managers and financial planners is to have a pulse on when things might be a bit ahead of their skis. Now, let me put this with a strong caveat, right? We've seen this over and over in the market where things tend to, be overweighted or expensive, and then eventually they come back. But that doesn't mean they can't appear to be expensive for years, right? So showing these things, what's difficult about this from our perspective is there's not necessarily a timeline on this, right? But it does, like what David was just saying, what it tells us is not necessarily, hey, this is time to swing from one to the other. What it tells us is this is a time where we definitely need to make sure we don't have all of our eggs in that one basket. It can be really easy to chase returns, but that can be a pretty dangerous strategy long term. So let's look at this in a different way. Okay, so this chart right here, these 9 squares, what this shows is value companies, core companies, or core funds, which are typically a kind of a blend of growth and value, and then pure growth companies. So as you go from left to right, you're going from value to growth. Okay, and then up and down, large companies are on top, mid-sized and small. So as you go top to bottom, you're going big to small. So large growth is here. And what we're showing is, based on this Morningstar criteria, okay, and this is one analysis, but we're seeing this from a lot of different places right now. Based on this Morningstar criteria, if we are above this one, so a 1 would be fairly valued, right? 1.1 then is going to be 10% overvalued compared to this Morningstar criteria based on historical earnings. Okay, so 10% overvalued would be 1.1, and then undervalued here, right? Like a 0.9 would be 10% undervalued. You're trading at 90% of the fair value. So what's the trend here? Well, the trend is growth right now appears to be expensive, right? 12%, 18%, 12% for small, 18% for mid, 16% for large. We're looking a bit overvalued. So what this means is like what David said earlier, even if these companies continued to have positive earnings, but us as consumers and investors just decided that we weren't willing to pay 40 times those earnings anymore, we're only willing to pay 30 times the earnings, that would mean a significant drop in price, right? And so this is what this is saying is if we're already overvalued, if we just come back to normal, there's going to be a reduction in price. So of course the growth side is looking expensive. The value side is looking like it's at a much better value, and particularly small companies appear to be at a very good value compared to large companies. Okay. Now, one caveat, one reason for this is because small companies are typically hit the hardest by high interest rates. A lot of times small companies are borrowing money to grow and fund their operation. When interest rates are high, that's gonna hit small companies harder. So a lot of reason, a big reason for this valuation is small companies have become cheaper over these last few years because people have been nervous about inflation and high interest rates. If that were to, or as that eventually regulates, small companies should get back to more of a fair value. Now, the tariffs and things like this and tax cuts and whatever happens next year could have an impact on this and an impact on inflation. But as we look at things right now, we want to make sure we have some mid and small exposure in our portfolios. Again, when we look at this over history, right, and we're back to looking at price to earnings ratios. So just remember, higher is more expensive, lower is less expensive. and we're looking at the S&P 500 in red, S&P 600, so this is the 600 small companies, in green. Okay, right now we've got a pretty big disparity between the valuations here. As you can see over time, when that has happened, there tends to be a meeting in the middle eventually, right? These tend to somewhat travel together. They may separate, they may cross for periods of time, but tend to come back into the middle here, which is what we expect to happen again. So what this either means is large companies come down in valuation, or small companies come up, or a combination of the two. Regardless, what this means is, even though we've seen all the growth come this year from the S&P 500, from large companies, we want to make sure not to chase that growth, put all of our eggs in that basket. We want to make sure to have some here in small as well. And again, we say this over and over. What we want to be sure is that nobody on this call takes this information and says, hey, they said that large companies aren't a good place to invest anymore, so I'm going to get out of the C fund and throw everything in the S fund. That is not the message, okay? The message is, even though the C fund has been the best performer this year and the S&P 500 has been the best performer this year, we need to be thoughtful and considerate about whether it makes sense to put all of our eggs there, all of our eggs in that basket, okay? So this is a message of diversification, not hedge fund type swinging from one to another. So same goes with growth and value, right? We've posted this on the last handful of commentaries. We want to maintain a balance of growth and value. We want to be mindful of concentration risk. That's something we didn't talk about too much today, but understanding, hey, when we're investing in a certain index, are a lot of our investments in only a handful of companies in reality? That's some concentration risk. We want to diversify. We want to have some small cap. We want to have some mid cap. We want to have even some international, especially if you can get that in an actively managed way, is a great diversifier right now. And then additionally, with interest rates being higher and being probably close to the peak of their range, this is a pretty decent time to consider bonds in your portfolio. If all of your safe money is in G fund right now, it could make sense to blend some F fund in there depending on your situation, right? So again, on these types of calls, this information that we're providing has to be broad to an extent. We're reaching a large audience. Every one of you that watches this is going to have a slightly different situation. And there's no way we can address every person's situation on these calls. So what we do is we offer a complimentary financial checkup where you are actually able to schedule a call with me, with David, with one of our other advisors or financial coaches, and you get to ask those questions that are specific to you. Roth versus traditional TSP, that's a huge one. How's my allocation in my TSP? Am I doing the right things? When should I take Social Security? I've seen a couple questions actually on this, this webinar that we're doing about Social Security and your FERS retirement and how all this works together. We can cover all of these things. In addition, we've got other videos on YouTube that have already pre-recorded that are covering some of these things. So check that out as well. But if you're interested in setting up this call, you can hit this QR code right here, or go to retfed.com/register. That sets you up for that complimentary call. It's an hour long. There's no obligation to do anything after, but it's a pretty great value. Now, David mentioned before, we're changing the programming a little bit on these webinars, on the monthly market commentaries anyway. We will be doing one just like this in January. From that point forward, our plan is to do it bi-monthly. So every other month we'll be doing one of these market commentaries. If you're subscribed to the page, our YouTube page, you'll still get a notification for when we're planning the commentaries, but it'll be every other month going forward. And the reason for that is really that, we give this message all the time that we don't want to be changing our portfolio all the time, right? We don't want to be moving things in and out and up and down and just blowing with whatever wind the market takes us. And so I think by what we've decided is when we do these things monthly, sometimes it can feel like whiplash, right? Or that we're giving too much information too fast, which causes people to kind of make changes and move things around, and that's not what we want to do. So we're gonna do them bi-monthly. We're gonna be very thoughtful about the information we provide, and we think that'll be better for everyone. So, David, anything to add before we wrap up for today?
No, I think that just about covers everything. So thanks for your time, everybody who joined live or who watches the recording afterwards. Like I said earlier, there's going to be a lot of information, I think, coming out next year with the tariffs, with the tax policy and changes. So we're going to have a lot of, let's call it more things other than just what's going on in the market to discuss next year. So make sure you tune in for those. Like Austin said, we're going to, the idea of also doing it bi-monthly is there's a lot of information that comes out, and that way we can be more selective about what are the most important things that you need to know, and hopefully that we can provide a little bit more guidance on kind of action items, let's call it, that you can use from that information. So thank you all again for your time. Also, hope everybody had a nice Thanksgiving. Should have led with that. But in addition to that, just before we tune out, I hope everybody has a good holiday season in New Year's. And we're looking forward to seeing everybody in 2025. As Austin was probably going to say, our next commentary is still going to be in January. But then from there, we'll be switching to a bi-monthly schedule.
Yep. All right. Well, I think I saw the questions get answered that came in the chat. So we'll just end it right there and go ahead and wrap up for today. So thank you, everybody, for joining in, and we'll see you next time.